Hello, friends. I'm really excited to have you here today because we're about to dive into some of the most powerful investing lessons from the legendary Warren Buffett, a man who's built one of the greatest fortunes in history by sticking to simple, timeless principles. In this video, I'll share 7 essential lessons straight from his famous shareholder letters, lessons that can completely change how you approach investing. Whether you're a beginner or someone looking to sharpen your skills, these ideas will help you invest smarter, avoid common mistakes, and grow your wealth steadily over time. We'll talk about things like knowing exactly what you're investing in, buying undervalued companies, thinking long-term, picking the right management, tuning out the noisy market, focusing on real cash flow and returns, and how to diversify, but only when it truly makes sense. So if you want to build your investing mindset like Buffett, stick around till the end. And hey, if you find this helpful, don't forget to hit that like button, share it with your friends, and subscribe for more easy-to-understand finance tips. Let's jump right in. Invest in what you understand, Warren Buffett's timeless wisdom. When it comes to investing, few voices are as trusted or as deeply respected as Warren Buffett's. Through decades of his shareholder letters, one message echoes clearly, calmly, and consistently. Invest only in what you understand. This principle isn't just a passing opinion. It's one of the core philosophies that has guided Buffett's unparalleled success. At the heart of this idea is a simple but powerful concept: your circle of competence. Imagine drawing a small circle around the areas where your knowledge runs deep. Industries you truly grasp, business models you can explain in plain language, and competitive dynamics you can analyze with confidence. That's your circle of competence. And Buffett's advice? Stay inside that circle. Buffett has always been candid about his limitations. He openly admits there are entire industries he doesn't fully understand and therefore avoids. Take the tech sector, for example. Back in the 1990s, when Silicon Valley was booming and everyone was rushing to buy shares of new, shiny internet companies, Buffett held back. Not because he didn't believe in innovation, but because he couldn't, at the time, confidently analyze the long-term durability of those businesses. While others chased fast money, Buffett stood by a principle. If you don't deeply understand how a company makes money, how it keeps its competitive edge, and how it responds to industry changes, you probably have no business investing in it. And this isn't about being an expert in everything. Buffett doesn't ask you to be a genius, just honest. Honest with yourself about what you know well, and equally honest about what you don't. He's famously said, what counts for most people in investing is not how much they know, but rather how realistically they define what they don't know. Let's break this down with an example from his own investments. Buffett has long championed companies like Coca-Cola. Why? Because the business model is easy to understand. They make drinks, people buy them, and the brand is globally recognized. He could see the competitive advantages, he could analyze the margins, and he could predict customer loyalty. It was firmly inside his circle of competence. Contrast that with a highly technical startup with a complex revenue model and no proven customer base. Buffett wouldn't touch it. Not because it's bad, but because it's outside his circle. He doesn't bet on potential. He bets on predictability grounded in understanding. There's also a deeper emotional truth to this principle. Investing in businesses you understand gives you confidence. And in the roller coaster world of investing, that confidence can be the difference between holding firm during a temporary market downturn or panic selling at a loss. Think of it this way. If you've done your homework, if you know the ins and outs of a company, if you trust its leadership and believe in its business model, you're far more likely to stay calm when the market gets turbulent. You're not reacting to noise. You're anchored by knowledge. This philosophy also keeps you grounded. In a world that constantly tempts investors with the next big thing, be it crypto, AI, or biotech, Buffett's reminder is clear. If it's not within your circle, let it go. The goal isn't to catch every trend. The goal is to build wealth sustainably and smartly over time. And it's not just about avoiding mistakes. It's about compounding success. By focusing your capital and attention on businesses you thoroughly understand, you give yourself the greatest chance of making sound, informed decisions. This long-term mindset is what separates seasoned investors from speculators. Buffett's partner, Charlie Munger, often says, "The wise man looks for what he can do, not for what he can't do." That perfectly aligns with staying inside your circle of competence. It's not limiting, it's empowering. It's about focusing your energy where you can make the most impact. So if you're an investor, especially a retail investor, take Buffett's advice to heart. Don't fall for the pressure to know it all or jump into every shiny new opportunity. Take the time to learn. Study businesses deeply. Build a circle of competence, no matter how small it starts. Over time, it will grow, but only through genuine understanding, not wishful thinking. Buy undervalued companies with a margin of safety. Imagine you're crossing a bridge. If the bridge is designed to hold 10,000 pounds and your car weighs only 5,000 pounds, you feel safe, right? That extra buffer, that comfort zone, is what Benjamin Graham called a margin of safety. And Warren Buffett? He didn't just adopt that idea, he built an empire around it. From his earliest letters to shareholders, Buffett has emphasized this core principle: only buy a business when it's available for less than it's worth, and make sure there's a cushion. That cushion, the margin of safety, is what protects investors from the unknowns, the surprises, and the inevitable ups and downs of the market. So, what does it really mean to buy a company with a margin of safety? First, we need to understand intrinsic value. Buffett defines intrinsic value as the true worth of a business, based on its fundamentals, its earnings, its assets, its growth prospects, and its ability to generate cash over time. This isn't about stock price fluctuations. It's about real, long-term value. Let's take Coca-Cola as an example. When Buffett bought shares in the company, he wasn't reacting to daily market noise. He analyzed its brand power, global distribution, customer loyalty, and future earnings potential. Then he compared that value to the price at which the stock was selling, and it was selling for less than it was truly worth. That gap between what something is worth and what you pay for it, that's where the margin of safety lives. It's the space that protects you from being wrong about some assumptions or from unexpected economic shifts. And it gives you peace of mind, not just profit potential. Buffett often says, price is what you pay. Value is what you get. If you confuse the two, you're setting yourself up for trouble. Just because a stock is cheap doesn't mean it's a bargain. The margin of safety isn't about buying any low-priced stock. It's about buying a quality business at a price that gives you room for error. Let's say you estimate a company's intrinsic value at $100 per share. With a margin of safety, you wouldn't buy it at $95 or even $90. You'd wait until it drops to $70 or $60. That way, even if you were a bit off in your calculations, or if the company faces temporary headwinds, you're still protected. That cushion is your friend. It gives you confidence. Buffett learned this from his mentor, Benjamin Graham, author of The Intelligent Investor. Graham taught him that smart investing is not about predicting the future perfectly. It's about minimizing the chance of permanent loss. And the margin of safety is the tool that makes that possible. Over time, Buffett refined Graham's ideas. Instead of just looking for cigar-butt stocks, companies that were cheap but deteriorating, Buffett began looking for wonderful businesses at fair prices. But even then, the margin of safety remained non-negotiable. Whether it was See's Candies, American Express, or Coca-Cola, every major investment he made came at a price significantly below the company's long-term value. Now here's where emotions come in. Markets are emotional. Investors panic, they get greedy, they overreact. Prices often swing wildly in the short term, while the actual value of the business barely changes. Buffett uses those emotional swings to his advantage. When fear drives prices down, that's when the margin of safety widens, and that's when Buffett moves. But this approach also requires patience. Buffett doesn't chase hype. He doesn't jump in just because everyone else is. He waits. He watches. He values discipline more than excitement. He says, the stock market is designed to transfer money from the active to the patient. This mindset gives retail investors a powerful advantage. You don't need to be a math genius. You just need to stay calm, do your homework, and wait for the right price. Buying a great company at an overpriced level can still lead to poor returns, but buying it with a margin of safety? That's where wealth is quietly built. Buffett's results speak for themselves. His focus on undervalued companies with a margin of safety has allowed him to grow capital steadily, even during recessions, crashes, and chaotic markets. It's not glamorous, but it works. So here's the takeaway. Don't just fall in love with a stock. Study it, estimate its real worth. Then ask yourself, am I getting this at a price that gives me room to breathe? Because in investing, like in life, safety doesn't limit your freedom. It protects your future. Focus on long-term holdings. In a world obsessed with quick wins, fast trades, and daily stock price updates, Warren Buffett stands as a calm, confident reminder of a powerful truth. The real magic of investing happens over the long term. His philosophy? Simple. Our favorite holding period is forever. That single line, repeated in his shareholder letters across the years, tells you everything about how he thinks and how he wins. Buffett doesn't believe in timing the market or riding temporary fads. He believes in owning pieces of great businesses, just like you'd own a farm or a family-run shop, something you'd stick with, nurture, and grow for years, even decades. He's not buying stocks. He's buying companies. And when he finds the right one, he holds on tight. Take American Express, for example. Buffett first bought into the company in the 1960s after a major scandal had sent its stock tumbling. While others were scared off, Buffett saw the enduring strength of the brand, the loyalty of its customer base, and the depth of its competitive moat. He held on. Decade after decade, through recessions and recoveries, through ups and downs, that investment has returned billions. Or look at Geico, now a wholly owned Berkshire Hathaway company. Buffett didn't just invest in Geico. He watched it for years, studied its business model, admired its low-cost structure, and its focus on customer value. He bought his first Geico shares in 1951. It took decades, but eventually, Geico became one of Berkshire's crown jewels. Why? Because Buffett had the patience to see the long-term picture, even when others didn't. This long-term view is more than a strategy. It's a mindset. Buffett sees investing like planting a tree. You don't dig it up every few days to check the roots. You water it, protect it, and give it time. Over the years, it grows strong and provides shade, fruit, and lasting value. That's how he sees owning a business. Not as a trade, but as a long-term relationship. In his letters, Buffett often emphasizes the idea of competitive moats. A moat, in business terms, is what keeps competitors at bay. It could be brand power, cost advantages, scale, or customer loyalty. When he finds a company with a wide and durable moat, he knows it's likely to survive and thrive for many years. That's the kind of company he's willing to hold forever. But let's be honest, holding on isn't always easy. Markets are noisy. Headlines scream panic. Prices swing. Buffett knows this better than anyone. But instead of reacting emotionally, he stays focused on the underlying business, not the stock chart. He trusts his homework, and he lets time do the heavy lifting. And here's the beautiful part. Long-term holding isn't just about maximizing returns. It's about minimizing mistakes. Constantly buying and selling introduces risks, taxes, fees, emotional decisions, missed opportunities. But when you commit to a solid business, bought at a fair price, and simply let it grow, you remove all that friction. You simplify your financial life. This approach also sends a powerful emotional signal. It says, I believe in this company. I'm not here for a quick buck. I'm here to grow with it. That mindset not only brings peace, it often brings better results. Buffett's letters also remind us that even the best businesses have rough patches. But if the fundamentals remain strong, a temporary dip is just that, temporary. Long-term holders have the chance to benefit from compounding, the eighth wonder of the world, as Einstein and Buffett like to say. And compounding works best when you leave your investments alone to grow over time. Even today, when technology has made trading as easy as tapping a screen, Buffett urges investors to resist the temptation of overactivity. He says, the stock market is a device for transferring money from the impatient to the patient. In other words, long-term thinkers win. This doesn't mean you should never sell. If the reasons you bought a business no longer hold, if the moat has disappeared or the management has failed, Buffett would agree it's time to exit. But those moments are rare. In most cases, the biggest gains come not from jumping ship, but from staying aboard through the storms. So what's the lesson here? Don't chase every trend. Don't jump in and out. Instead, take the time to truly understand a business. Wait for the right price, then buy and hold. Let that tree grow. Let compounding do its quiet, powerful work. Look for strong management. Warren Buffett is known for his deep dives into financial statements, business models, and economic moats. But behind all the numbers, one truth always shines through in his letters to shareholders. The people running a business matter just as much, if not more, than the business itself. Yes, Buffett analyzes balance sheets. Yes, he studies margins and returns on capital. But ultimately, he asks a human question. Who's in charge? And do they act like an owner or just an employee? Time and again, Buffett has emphasized that strong, trustworthy, and rational management is a cornerstone of long-term success. In fact, when he evaluates a company, he looks at three things. 1, is it a business he understands? 2, does it have a durable competitive advantage? 3, and most importantly, is it run by able and honest people? Let's explore why that third pillar, strong management, matters so deeply in Buffett's world. At Berkshire Hathaway, Buffett has built a unique system. He owns dozens of companies across industries, insurance, energy, retail, transportation, but he doesn't micromanage them. Why? Because he selects managers he trusts, then gives them full autonomy. These aren't just CEOs. Buffett calls them business artists, people who love what they do and think like owners. He especially values managers who are rational capital allocators, leaders who deploy earnings wisely, reinvest in high-return projects, and return excess cash to shareholders when appropriate. When managers treat the company's money as if it were their own, Buffett sleeps well. A perfect example is Ajit Jain, who runs Berkshire's insurance operations. Buffett has repeatedly praised him as one of the smartest and most disciplined risk managers in the world. Jain isn't flashy. He's thoughtful, methodical, and fiercely rational. And that, in Buffett's eyes, is gold. On the flip side, Buffett has never hesitated to criticize poor management practices, especially when it comes to capital allocation. In many of his letters, he calls out companies that waste shareholder money on overpriced acquisitions, excessive executive perks, or irrational stock buybacks. To Buffett, the job of a CEO isn't just to grow, it's to grow wisely. He once wrote, "The lack of attention to capital allocation is a blind spot in corporate America." He's seen far too many CEOs driven by ego, buying businesses for bragging rights, not for value. That kind of behavior destroys shareholder wealth, and Buffett wants no part in it. Another key trait he looks for? Candor. Buffett has immense respect for managers who are brutally honest about both successes and failures. In his own letters, he's known for admitting mistakes with humility, like his misjudgment on Dexter Shoe Company or not buying Google early on. And he expects the same transparency from others. In fact, Buffett has long admired Tom Murphy, the legendary executive behind Capital Cities ABC, for his no-nonsense, straight-talking leadership. Murphy didn't sugarcoat problems. He faced them head-on, made hard decisions, and built a media empire on discipline, not fluff. Buffett also celebrates frugality and integrity. He finds charm in managers who operate with a sense of responsibility, not lavish corporate jets and grand headquarters. He wants leaders who focus on building value, not status. It's no surprise that many Berkshire companies have leaders who still drive modest cars and avoid unnecessary spending, despite running billion-dollar businesses. This approach stems from Buffett's belief that character compounds just like capital does. A good manager today will likely be a good manager 10 years from now, if they have the right values. But a weak or greedy one? They can erode even the best business over time. And perhaps the most remarkable part of Buffett's philosophy is this. He doesn't just tolerate strong management, he celebrates it. In many shareholder letters, he devotes entire sections to praising the unsung heroes within Berkshire's subsidiaries. He writes about their work ethic, their decisions, their long-term thinking. He shines the spotlight on them, not himself. Why? Because he knows that behind every great business story is a person making smart, honest choices day in and day out. Numbers don't make themselves. It's people who drive the engine. And when you find the right people, ones who think long-term, who treat the business like it's their own, who don't chase headlines but chase excellence, you've found something truly rare. Ignore market noise. Picture this. The stock market crashes. News anchors sound the alarm. Social media spirals into panic. Investors rush to sell. Everywhere you look, it's fear, noise, and chaos. But in the middle of it all, Warren Buffett sits calmly, perhaps reading a book, sipping a cherry Coke, and looking for his next great investment. Why? Because Buffett has mastered a lesson most investors never learn. Don't get distracted by market noise. Focus on value, not volume. In nearly every one of his letters to shareholders, Buffett returns to this theme. He urges us to tune out the daily drama of Wall Street and focus on what really matters, the long-term performance of the businesses we own. He's not interested in where the stock market will go tomorrow. He cares about where a company will be 10 years from now. His legendary advice? Be fearful when others are greedy, and greedy when others are fearful. That quote isn't just catchy, it's a map for navigating uncertainty. During times of fear, like the 2008 financial crisis or the COVID-19 crash in 2020, Buffett doesn't panic. He gets excited, because while others are selling in fear, he sees bargains, opportunities, undervalued gems. You see, Buffett understands the psychology of markets. He knows they're not always rational. In fact, they rarely are. Stocks rise and fall not just because of facts, but because of emotions, fear, greed, speculation, and herd mentality. And if you let those emotions guide your decisions, you'll end up buying high and selling low. That's why Buffett calls the market Mr. Market, an imaginary business partner who offers to buy or sell you shares every day at different prices. Some days he's optimistic, other days he's depressed. But here's the key. You're under no obligation to listen to him. If Mr. Market offers you a foolish price, Buffett says, ignore him. If he offers you a great deal, take it, but never let his mood dictate your actions. Because when you focus on price over value, you become a speculator, not an investor. Buffett's letters often remind us that the market is there to serve us, not instruct us. That's a powerful shift in mindset. It puts you in control. You're not a leaf in the wind of market movements. You're the captain of your ship, charting a course based on long-term fundamentals. And make no mistake, Buffett has had his share of turbulent markets. But he never runs from volatility. Instead, he welcomes it. In fact, some of his best investments came when others were running scared. Take his massive investment in Bank of America during the financial crisis. Or his decision to double down on American Express during its salad oil scandal in the 1960s. In both cases, the market was screaming sell. But Buffett saw strength, durability, and long-term potential. What allowed him to act with confidence while others panicked? A deep understanding of the business, a focus on intrinsic value, not the stock ticker, and the emotional discipline to block out the noise. He often jokes that if the stock market shut down for 10 years, he wouldn't care, as long as the businesses he owns continue to grow. That's the level of conviction he wants all investors to have. Not to be obsessed with short-term price action, but to anchor themselves in long-term business value. Another key point Buffett drives home. You don't need to act every day. The market might give you thousands of data points a week, but most of it is just noise. Real investing, he says, is about waiting patiently for the fat pitch, the rare opportunity when price and value meet. This idea is liberating. It means you don't have to chase the market. You don't have to respond to every headline. You can sit still, observe, and act only when it truly makes sense. So how do you apply this lesson? Stop checking prices every hour. Ignore the hype and fear cycles. Study businesses, not stock charts. And most importantly, develop the courage to trust your own judgment, even when the crowd screams otherwise. Prioritize cash flow and return on equity. If you asked Warren Buffett to strip investing down to its purest form, he'd likely say this: show me the cash. Not just revenue, not just profits on paper, but real, tangible, predictable cash flow. The kind that can be reinvested, paid out as dividends, or used to buy back shares. And alongside that, Buffett wants to see a high return on equity, ROE, a sign that the company is using its capital wisely. In his letters to shareholders, Buffett consistently emphasizes that cash flow and ROE matter far more than accounting illusions or market hype. These two metrics, he says, tell the real story of a business's strength and its future potential. Let's break this down. Starting with cash flow. Buffett isn't impressed by complex financial engineering or temporarily inflated earnings. He looks for businesses that generate consistent free cash flow, the money left after operating expenses and capital expenditures. Why? Because that's the cash available to grow the business or reward shareholders. One of Buffett's favorite examples is See's Candies, a small but mighty business Berkshire Hathaway acquired in the early 1970s. Year after year, See's produced more cash than it needed to maintain its operations. Its secret? Pricing power, loyal customers, and a simple, capital-light model. See's didn't need to constantly build new factories or spend on heavy equipment. It just needed to keep making delicious chocolate and deliver it with care. And that allowed Buffett to take the extra cash and invest it elsewhere, compounding wealth across Berkshire's empire. This is what Buffett means when he talks about cash cow businesses, companies that throw off more money than they need, allowing that cash to be deployed into other high-return opportunities. Now let's talk about return on equity, ROE, a measure of how efficiently a company turns shareholder money into profit. To Buffett, a high ROE signals that management is making smart decisions with your investment. They're not just growing for the sake of growth, they're building value. And if a company consistently earns, say, 20% on its equity, that means it can double its value roughly every 3.5 years without raising new money. That's powerful because it tells you the business has a durable advantage, a moat that protects its profitability. And for Buffett, moats are everything. He wants businesses that are not only efficient, but also defensible over the long haul. Buffett also warns about companies that juice their ROE numbers by taking on lots of debt. A business that uses leverage to inflate returns might look impressive at first, but it's a house of cards. One economic storm, and the whole thing can collapse. Instead, Buffett seeks high ROE businesses with little or no debt. That's why companies like Apple or Moody's attract him. They earn strong returns on capital without putting the balance sheet at risk. Another key point, Buffett doesn't just care about how much a company earns. He cares about what it does with that money. He praises businesses that reinvest in high-return projects and criticizes those that waste cash on overpriced acquisitions or status-driven spending. In several letters, he's explained how compounding works best when profits are reinvested at high rates of return. That's how Berkshire Hathaway itself became a giant. It took the excess cash from See's Candies, GEICO, and other subsidiaries and channeled it into other cash-rich, high ROE businesses. And unlike flashy tech startups burning through cash with no clear profit model, Buffett prefers boring, steady businesses, the kind that quietly churn out cash year after year through recessions, interest rate swings, and whatever the market throws their way. His message is clear. If a company's financial engine is purring smoothly, producing strong, reliable cash flows, and earning high returns on equity, you've found something rare, something valuable, something worth holding on to. So, what does this mean for you as an investor? Don't chase hype, study the numbers. Look for real, repeatable cash generation, not just theoretical earnings. Avoid companies that rely heavily on debt to impress you. Ask yourself, is this business truly efficient at turning money into more money? And finally, understand what management is doing with that cash. Are they growing wisely or spending recklessly? Because in Buffett's world, success isn't measured by how loud a company is. It's measured by how quietly and consistently it creates wealth, through disciplined reinvestment, strong cash flows, and smart use of equity. Diversify selectively. In the world of traditional investing, there's one golden rule that's drilled into everyone's mind. Diversify. But Warren Buffett, he takes a deep breath, smiles gently, and says, "Not so fast." Yes, Buffett agrees that diversification protects you. But he also believes that too much diversification can hurt you, diluting your best ideas, blurring your focus, and ultimately watering down your results. In his shareholder letters, Buffett never screams for concentration, but he quietly demonstrates it through the way Berkshire Hathaway invests, the way he talks about conviction, and the way he honors the power of knowing what you own. Let's unpack what he really means by diversify selectively. Buffett's guiding principle here is crystal clear. Put your eggs in a few baskets and watch those baskets carefully. You see, the more stocks you own, the harder it becomes to understand each business deeply. Buffett believes that knowledge and insight, not quantity, drive success. If you know 3 companies inside out and you trust their leadership, competitive position, and future cash flow, why would you dilute your portfolio with 50 more names you only half understand? This is where the concept of circle of competence comes back into play, a recurring theme in Buffett's writing. He encourages investors to stick with industries and companies they truly understand. And once they find something great within that circle, it's okay to go big. Take a look at Berkshire Hathaway's portfolio through the years. At any given time, it's had massive exposure to a few select names: Coca-Cola, Apple, American Express, Moody's. These aren't just investments, they're partnerships. Buffett didn't sprinkle money across 100 companies. He went in deep with the ones he believed in most. Why? Because he studied them relentlessly. He saw moats, cash flow, pricing power, and world-class management. And rather than spreading his bets, he stacked them on quality. Buffett often points out that over-diversification is really just a hedge against ignorance. If you don't understand what you're investing in, then yes, you'll want to own a little bit of everything just in case. But if you do the hard work, if you dig deep, and if you truly know your businesses, then concentration isn't risky. It's rational. In fact, he once said, "Wide diversification is only required when investors do not understand what they are doing." Now, to be clear, Buffett isn't telling the average retail investor to dump their index funds and load up on just 3 stocks. He understands that most people don't have the time, tools, or temperament to analyze businesses deeply. For them, diversification is protection. It's insurance. But for investors who do the homework, who study annual reports like novels, who ask tough questions about return on equity and reinvestment potential, then owning 10 or even fewer companies is not only acceptable, it might be preferable. Another layer to this philosophy is patience. Buffett doesn't switch in and out of companies every month chasing trends. His concentrated bets are often held for decades through recessions, market crashes, and economic cycles. Because once he finds a business that compounds capital reliably, he's in no rush to move on. This long-term holding period further reduces the need for diversification. Why spread yourself thin when your top investments are already compounding wealth at 15 to 20% annually? Buffett also critiques the idea of diversification in mutual fund management. Many fund managers feel pressured to own dozens or even hundreds of stocks to appeal to clients and reduce volatility. But in doing so, they often sacrifice performance for the illusion of safety. Buffett calls this diversification, a clever twist on the idea that sometimes adding more can actually make things worse. His letters invite investors to think differently. What if less is more? What if focus, clarity, and conviction lead to better outcomes than constant hedging and spreading? What if the best investment strategy is actually choosing carefully and staying put? So what's the takeaway for us? If you aspire to invest like Buffett, study deeply, act selectively, and hold patiently, then don't fear a focused portfolio. Embrace it. Use diversification not as a default, but as a deliberate choice. And that's a wrap on these 7 powerful investing lessons from Warren Buffett. If you enjoyed this video and found these lessons helpful, please hit that like button, share it with your friends, and don't forget to subscribe so you never miss out on more practical investing wisdom. Thanks for watching, and until next time, keep learning, keep investing, and keep growing. See you soon.